Here is the question no one in finance wants to answer out loud. If bonds are safe, if they genuinely protect your wealth, why do they keep failing the people they're supposed to protect? Not in exotic markets, not in developing countries, in America, in Germany, in Switzerland, in the retirement accounts of people who did everything right. 4 episodes, 1 answer. This is the final chapter. We've been building toward this. Episode 1, what bonds are and what the brochure leaves out. Episode 2, the 25-year scorecard and the number that changes everything. Episode 3, the crashes, 1994, 2013, 2022, the year a seatbelt turned into a trap. Now we close it. Not with another crisis, not with another chart, but with something more important. The 5 structural flaws baked into bonds that no interest rate cycle, no central bank, no policy shift can ever fully fix. These aren't things that went wrong. These are features of the instrument itself. And once you see them, you cannot unsee them. We actually did a full breakdown on Patreon of how to preserve your assets in times of uncertainty. If you want to know more about how to manage your finances and get serious in-depth analysis on economics and geopolitics, join us there, link in the description. Now, back to the verdict. Structural flaw number 1, duration. The risk that scales with safety. The longer your bond, the more sensitive it is to rate changes. That's not an opinion. That's mathematics. A 2-year treasury has limited exposure. A 30-year treasury is a different animal entirely. A 1% rise in interest rates costs a 30-year bond roughly 18 to 20% of its value. 3% rise, which is what we saw in 2022, and you're looking at losses of 35 to 40%. Here's the cruel irony. The bonds most marketed as safe, long-dated government bonds, the backbone of pension funds, the foundation of conservative portfolios, carry the highest duration risk. The product designed to protect you is the one most exposed to the thing that destroys it, and there's no way around it. Duration is the price of the coupon. You want the income, you accept the exposure. The flaw isn't a bug, it's the architecture. Structural flaw number 2, inflation. Bonds are promises written in yesterday's money. A bond pays you a fixed coupon, fixed, in nominal terms. If you buy a 10-year bond yielding 3% and inflation runs at 4%, you are losing purchasing power every single year while believing you're being conservative. This is the silent theft. It doesn't show up in your statement as a loss. Your balance says you're earning, but what you can buy with that money next year, in 5 years, in 10 years, is shrinking. Bonds were designed for a world of stable, low inflation. They have no mechanism to adapt. No automatic adjustment, no built-in hedge. When inflation rises, equities can raise prices, expand margins, grow earnings. Bonds just sit there, paying you a coupon that's worth less every year it arrives. The 2022 episode wasn't an accident. It was the logical endpoint of using a fixed nominal instrument in a world of rising real prices. Inflation doesn't just hurt bonds, it exposes them. Structural flaw number 3, the correlation collapse. For decades, the 60-40 portfolio was built on one assumption. When stocks fall, bonds rise. The negative correlation, the diversification, the seatbelt. In 2022, stocks fell 20%, bonds fell 13 to 35% at the same time. This wasn't a black swan. Financial historians had been warning about it for years. In inflationary environments, as opposed to deflationary crises like 2008, bonds and stocks often fall together. Because the same thing that crushes corporate earnings, rising rates, also crushes bond prices. The negative correlation isn't a law of finance. It's a pattern that held for roughly 40 years, from the early 1980s to 2020, a specific, historically unusual period of falling inflation and falling rates. That period is over. The assumption that made 60-40 work no longer holds, and tens of millions of retirement portfolios are still built on it. Structural flaw number 4, the yield flaw, when the math breaks. In 2020, Switzerland's 10-year government bond yielded minus 0.8%. Think about what that means. You lend money to a government for 10 years, and the contract guarantees you receive less back than you started with. The concept of a safe return ceases to exist. There is no return. There is only a question of how much you lose. Between 2015 and 2022, roughly $18 trillion in global bonds traded at negative yields. $18 trillion of capital in instruments mathematically guaranteed to lose money in nominal terms, before even considering inflation. This isn't a temporary aberration corrected by the market. It was the direct result of central bank policy, quantitative easing, zero interest rate policy, and the purchase of sovereign debt on a scale never seen in modern financial history. The central banks became the buyers of last resort. And when the largest buyer in the market is price insensitive, when it will purchase regardless of yield, the pricing signal breaks. Bonds stopped being market instruments, they became policy tools. And retail investors were along for the ride, often without knowing it. Structural flaw number 5, the risk-free label, the most dangerous words in finance. We call government bonds risk-free. It's in every finance textbook, every CFA exam, every investment prospectus. It's wrong. Default risk, the risk that a government fails to repay, is low for developed nations. That part is true, but default is only one kind of risk, and it may be the least likely to hurt you. Duration risk, your bond loses 35% in a rising rate environment, not risk-free. Inflation risk, your real purchasing power erodes for an entire decade, not risk-free. Currency risk, your dollar-denominated return converted back to euros or francs at an unfavorable exchange rate, not risk-free. Liquidity risk. In a crisis, even government bond markets can seize up, spreads widen, and selling becomes costly, not risk-free. Reinvestment risk. The coupons you receive get reinvested at lower and lower yields as rates fall. The total return you expected never materializes. Not risk-free. The risk-free label was always a simplification, a shortcut for financial modeling. It was never meant to be taken literally by someone deciding where to put their retirement savings. But it was, and it is, every day. The verdict: bonds are not evil instruments. They are not scams. They are not worthless. In short durations, in deflationary environments, as a tactical tool for managing volatility over a specific horizon, they play a legitimate role. For an investor 5 years from retirement, facing a genuine need to preserve capital over a known timeframe, bonds belong in the conversation. But the universal prescription: put some in bonds, it's safe, handed down for 40 years, inherited from a specific historical window that no longer exists. To investors who don't understand duration risk, who don't adjust for inflation, who believe negative correlation is a permanent feature of markets, that prescription has cost people money. Real money. Irreplaceable retirement money. In 1994, in 2013, spectacularly, historically in 2022. The question was never whether bonds belong in a portfolio. The question was, which bonds, in what proportion, for what purpose, under what conditions, and what are you giving up to hold them? That question was never asked, and that silence was expensive. What comes next? This series started with a simple sentence: put some of it in bonds. It's safe. We've spent 4 episodes examining that claim from every angle: the mechanics, the 25-year returns, the crashes, the structural flaws. And if the conclusion is uncomfortable, if you're now looking at your portfolio with different eyes, that discomfort is the point. Clarity is always worth the short-term unease. Which brings us to the question that now demands an answer. If not bonds, or not bonds alone, then what? When the environment is uncertain, when inflation is unpredictable, when geopolitics is shifting, when the conventional playbook has failed, how do you actually preserve and grow your assets? That's the next series: how to preserve your assets in times of high uncertainty. Not a generic answer, not a list of tips. A structured, rigorous framework for thinking about asset preservation, across currencies, across asset classes, across geopolitical risk, built for the world that actually exists today, not the one the textbooks were written for. This has been the Bond Series. 4 episodes, no spin, no financial product to sell you, just the numbers, the history, and the analysis you were never given by the people who were supposed to give it to you. If this series made you think differently, share it, because every person who makes a better informed decision about their financial future does so because someone showed them a different frame, Be that person for someone you know. Subscribe to Curiosity Matters, the link is right below. And if you want to go further, the in-depth analysis, the geopolitical context, the private reports on economic risk and asset preservation that go far beyond what a YouTube series can hold, that lives on Patreon. Every week, independent, rigorous, built for people who take their financial future seriously. Link is in the description. We'll see you in the next series.